Welcome to this explainer. Today we're popping the hood on the operational machinery of an absolute global life sciences giant, Danaher. We're going to break down their Q1 2026 financial trajectory, look at their strategic acquisitions, and unpack the current Wall Street outlook, pulling all of this straight from their latest earnings reports, press releases, and financial data. Let's get right into it. Quickly, here's our roadmap. We'll hit the Q1 2026 financial scorecard, do a segment performance breakdown, discuss the Masimo acquisition, touch on quality and sustainability, look at FY 2026 guidance, and wrap up with Wall Street's perspective. Okay, Section 1, the Q1 2026 financial scorecard. Right out of the gate, Danaher posted a massive $6 billion in Q1 sales. That represents a 3.5% year-over-year overall growth. Now, what makes this genuinely impressive is they achieved a 0.5% in core revenue growth. And they did this despite facing a known 2.5% headwind from a drop in respiratory revenues. The rest of their core business actually grew by roughly 3%, so really solid resilience there. And that top-line resilience brilliantly translates to bottom-line strength. They pulled in $2.06 in adjusted diluted net earnings per share. That's a very solid 9.5% increase from the exact same period last year. So what does this tell us? It shows that even with somewhat modest top-line growth, they are successfully converting revenue into serious shareholder value. Their operational efficiency is an absolute standout metric. While they maintained a strong 60.3% gross profit margin, the adjusted operating profit margin actually expanded to 30.2%. That's a 60 basis point expansion year over year. Management noted this was fueled by aggressive cost savings that totally offset the negative hit from lower respiratory testing revenue. To cap off this scorecard, they generated a formidable $1.1 billion in free cash flow during the quarter. That gives us a free cash flow to net income conversion ratio of 105%. This right here is the financial engine that sets up an incredibly strong balance sheet for future capital deployment, which we are going to see in action in just a minute. Moving on to Section 2, the segment performance breakdown. Looking under the hood, we definitely see some mixed dynamics at play. Biotechnology is absolutely thriving right now with 7% core growth. Life Sciences is holding steady with a slight 0.5% uptick. Diagnostics, on the other hand, saw a 4% contraction. But honestly, that's largely a normalization effect, just naturally coming down from the massive pandemic-era surge in rapid respiratory testing. Let's drill down into biotechnology for a second, because it is the clear standout. We're seeing high single-digit growth in bioprocessing consumables, completely driven by robust global demand for commercialized therapies, particularly in China. But get this, the most staggering metric is a 30% jump in bioprocessing equipment orders. That's the first quarter of year-over-year equipment order growth in nearly 2 years. Since equipment is bought well before production actually happens, this is a massive leading indicator signaling strong future capacity needs. Conversely, we do have to acknowledge the reality in diagnostics. That 4% core revenue contraction was entirely expected. As respiratory testing normalizes down from its recent peaks, it created a 2.5% headwind for the entire company. But as you'll see, Danaher is definitely not just sitting on their hands in this segment. Which brings us to Section 3, the Masimo acquisition. Completed in June 2026, Masimo is now a wholly owned subsidiary of Danaher. This acquisition is a huge deal. It brings specialized pulse oximetry and advanced AI-enabled patient monitoring into the fold, operating directly within Danaher's diagnostics segment as a standalone brand. Executive Vice President of Diagnostics Julie Sawyer-Montgomery perfectly summarized the strategic logic here. She noted that together they expect to strengthen their ability to deliver differentiated products in acute care settings and accelerate Masimo's growth and global reach. It's a classic synergy play, marrying Danaher's massive global reach and operational discipline with Masimo's highly differentiated, AI-enabled acute care tech. Financially speaking, this merger is modeled to deliver high single-digit returns by year 5 and is expected to further expand operating margins. Now, it does require taking on some debt, putting leverage at about 2.5 turns net debt to EBITDA post-close. But remember that massive cash flow we talked about earlier? With over $5 billion in expected free cash flow for 2026, Danaher is in a prime position to deleverage really quickly. Section 4, Quality and Sustainability. The Danaher Reliability System, or DRS, is a core component of the broader Danaher Business System. This six-pillar framework is the actual operational engine keeping product quality high, minimizing defects, and protecting those 30% profit margins we saw. It literally touches everything from design to manufacturing, all the way to post-market customer support. A vital piece of that puzzle is strict supplier quality management. For instance, Danaher requires all suppliers to commit to being conflict-free. That means they strictly avoid sourcing conflict minerals like tin, tantalum, tungsten, and gold from compromised areas. It's all about ensuring ethical sourcing throughout their entire global supply chain.
All right, Section 5, FY 2026 Guidance.
Looking ahead, management remains highly optimistic. Driven by a strong Q1, they've actually raised their full-year adjusted earnings per share guidance to a range of $8.35 to $8.55. They're projecting a healthy 3% to 6% core revenue growth for the year. This assumes that respiratory revenue finally settles into an endemic run rate, basically a stable, predictable post-pandemic baseline of about $1.6 to $1.7 billion. However, we have to objectively note the risks they've communicated too. Management projects a $75 million to $100 million revenue headwind driven by shifting policy and market dynamics in China. It's a factor they are actively managing for sure, but it is built into their models for the rest of the year.
Finally, Section 6, Wall Street's Perspective. Based on ratings from 28 analysts provided by Benzinga, we're looking at a consensus price target of $249.31. But those estimates represent a fairly wide range, from a low of $200 from Piper Sandler all the way up to a high of $315 from Stevens & Co. This suggests there are definitely varied expectations out there on exactly how quickly segments like bioprocessing will accelerate.
With the stock recently trading around the $194 mark, the latest analyst rating from Evercore ISI Group sets a $230 target. That implies a roughly 18% upside over the next 12 months, which really signals a lot of confidence in Danaher's ability to execute on its guidance and smoothly integrate new assets like Masimo. So we'll leave you with this to chew on. As pandemic-era testing revenues finally fade into the background, will Danaher's heavy investments in bioprocessing capacity and their aggressive move into AI-enabled acute care be enough to maintain or even expand their market leadership? Thank you so much for joining us for this explainer, and keep learning.